Imagine having an inside look at the moves made by some of the most brilliant financial minds in the world. In this breakdown, we're diving deep into the latest 13F filings to see how legendary investors like Bill Ackman, Manish Pabrai, Michael Burry, and Warren Buffett are shifting their portfolios in response to current market trends. These strategic decisions could signal major market shifts and could potentially reshape your investment approach. Let's explore what's driving their choices and what these moves might mean for the future of key sectors and stocks. Let's kick off with Bill Ackman, whose recent acquisition of Nike stock is particularly intriguing. With Nike facing a period of stock decline following underwhelming earnings reports, Ackman's decision to buy suggests he's playing the long game, betting on the iconic brand's resilience. Nike's strength lies in its global recognition and consumer loyalty, which Ackman likely sees as reasons to believe that the company can recover from its current struggles. For investors, this might be a case of looking beyond the present challenges to capitalize on the rebound of a well-established, trusted brand. Moving on to Manish Pabrai and Guy Spier, these two value investors have taken a somewhat contrarian stance by investing in coal miners, specifically those involved in metallurgical coal, which is vital for steel production. While the coal industry overall is in decline, driven by environmental concerns and the shift to cleaner energy, metallurgical coal remains in demand due to its essential role in construction and infrastructure projects worldwide. Pabrai and Spier's bet reflects a belief in the continuing necessity of steel production, despite the broader trend of divestment from fossil fuels. This could suggest that in specific sectors, demand-driven commodities like metallurgical coal can still offer lucrative opportunities. Then we have Michael Burry, known for his foresight in predicting the 2008 financial crisis. Burry's recent investment activity reveals a strong conviction in the future of Chinese tech stocks, even as the sector grapples with economic headwinds and regulatory challenges. Doubling down on Chinese tech indicates that Burry is focused on the long-term potential of these companies, banking on their ability to thrive in the face of short-term adversity. It's a bold move that reinforces the importance of patience in the face of market volatility, particularly when investing in sectors with strong underlying fundamentals, even if they're temporarily out of favor. On the opposite end of the spectrum, Seth Klarman has chosen to reduce his stake in Google significantly. This reduction comes at a time when tech valuations are soaring, and Klarman's move can be seen as a cautious approach, capitalizing on the high valuations to lock in profits. Klarman's exit from a portion of his Google holdings may be a signal of concern over the sustainability of tech stock prices in a market that many believe could be overvalued. For investors following Klarman's strategy, this could be a cue to reevaluate exposure to tech, particularly in an environment where future earnings growth may not justify current valuations. Finally, the most striking move of them all comes from Warren Buffett. Known for his long-term approach, Buffett's decision to sell nearly 50% of his stake in Apple caught many by surprise. Despite Apple being one of Berkshire Hathaway's largest and most successful investments, Buffett's sell-off suggests that he is mindful of Apple's current valuation, which has risen sharply in recent years. His decision to lock in profits while still maintaining a substantial position indicates a delicate balance between cashing out gains and continuing to believe in Apple's future. For investors, this is a lesson in disciplined profit-taking without completely abandoning a strong performer. The recent moves by these investment titans offer a fascinating glimpse into how top minds are positioning their portfolios in today's market. Ackman's confidence in Nike's recovery, Pabrai and Spier's contrarian bet on coal, Burry's long-term outlook on Chinese tech, Klarman's cautious trimming of Google, and Buffett's profit-taking in Apple all reveal different approaches to navigating current market conditions. Each of these decisions is informed by a mix of short-term caution and long-term optimism, demonstrating that even in uncertain times there are opportunities for those who know where to look. As you consider your own investment strategies, the key takeaway is clear. Understand the broader market trends, but also be willing to take calculated risks, lock in profits when necessary, and focus on sectors and companies that are positioned to grow over the long term. These top investors are showing us the value of adaptability in a constantly shifting financial landscape.